We're not just doing this for money. We're doing it for a load of money.
Welcome to the Money Tree Show, where we bring you high-level multifamily investors as well as industry-leading experts. We tease out the skills they've acquired, the habits, and the mindset they've developed to make them ultra-successful in the real estate space. It is our goal to give you the knowledge you need to either start your multifamily journey or expand your current portfolio. Whether you're an active investor or looking for a passive investment to supplement your income, this is the podcast for you.
Well, welcome everyone to the Money Tree Show podcast. I'm your host, Matt Damon, with my co-host, Anthony Vandermeer. And today we have our good friend, Kevin Kozak. Kevin, how are you today?
Doing well, gentlemen. Thank you for having me on. I appreciate it.
Dude, we're excited to have you on and hear your story. Hey, can you share with us, kick off by sharing with us, how'd you get into real estate? What's your background? Who are you, Kevin?
Absolutely. So I grew up in Vernon, Connecticut, just outside of Hartford. And I joined the Marine Corps right out of high school, which is where I met my now business partner, Ethan. So Ethan lives outside of Columbus, Ohio. I still live in Vernon, Connecticut. And pretty much both went in as reserve and stayed in, really good contact, bounced ideas off of each other, did the whole YouTube University, BiggerPockets and podcasts, audiobooks, all that. And ultimately just kind of boiled down to we were both doing things we didn't really want to do. I was working union construction, and Ethan was working as a paramedic in Columbus, and kind of had a good base of what it would look like if we started doing some direct to seller marketing on the residential side. And we set a marketing budget, said, hey, we'll pull the plug in 6 months if this doesn't work. And that was March of 2021, and started marketing, on my first trip out to Ohio in March. We bought a flip and put a Burr deal under contract, and just the past 2 years have really flown by. So happy to dig into any portion of that more, but that's kind of the quick backstory of how we got started in real estate and a little bit of our history.
Kevin, what made you want to jump into real estate? You're working construction, you get out of the Marines, you're hanging about. What makes you even think like maybe real estate's an option that I want to pursue?
Yeah, so I think it first started actually in training. Ethan and I were roommates in combat engineer school, which is our job within the Marine Corps. And on the same day, we both watched a BiggerPockets Burr video, but we didn't share it with each other. And like a couple days went by, and I was still like spinning the idea around. And little did I know, Ethan had watched the same video on the same day. And I brought it up with him, and he's like, hey, I just watched that. And to us, it just seemed like a very practical way from, coming from a place where we didn't have a lot of like personal capital to invest, to build wealth, specifically with the Burr strategy, along with fixing and flipping properties to kind of generate some cash as well. So that's, I think, really what kind of led us into real estate initially.
Talk to us about your first real estate transaction. So you're in Vernon, Connecticut. Ethan is in Columbus, Ohio. Where'd you guys go for your first deal? Yeah,
so Ethan and I both actually did like a personal deal prior to jumping in. So I bought a duplex in Vernon, Connecticut. It was kind of like a fixer-upper. I bought it with a 5% first-time homebuyer conventional loan, fixed up one unit, rented it out, fixed up the other unit, moved into it. Just given market conditions, I kind of saw, it looks like we're at the peak. This is end of the year 21. And I'm like, let's throw this thing on the market. It ends up more than I think it'll sell for the foreseeable future. So that was my first personal deal. Ethan did a Burr deal, which is actually still his personal residence in Ohio. So we both kind of had a taste of the transaction and, the possibilities, worked out the kinks on our own. And then the first Burr deal we bought in Ohio was actually a for sale by owner. And the guy had it listed for close to $100,000. We went and walked it with him while I was out in Ohio, and pretty much threw together some rough numbers. We made him an offer for 55. He kind of laughed and goes, I've got an offer for more than that. And, I think he just kind of gave us a shot. I was like, what, I'm doing all right. I don't need to squeeze all the juice out of it. And I think, the age card definitely helped us there. So we ended up buying that for $55,000. Put about 55 into it with work and holding costs. It appraised for 190. We burred out 80% of that. So 150,000, paid off the 110 that we had raised through a private lender and a hard money lender. Took the 40,000 and went, something here. So that was kind of our, first deal. It definitely took a while to actually burr out of it, but overall, just a super forgiving property and project to take down, especially just starting out.
Nice. And question for you regarding back kind of to the Burr model. It's amazing that you guys both listened to that same video on like the same day without realizing it. I know you guys have solid partnership. Was there any intention in the beginning saying, hey, let's first do a deal by ourselves? So this way we kind of get the kinks out. Like, was that part of it, or just so happened that you guys each do your own deal and then partnered up?
I think a little bit of it was it just so kind of happened to work out that way. Because we both bought those properties in 2020. Ethan actually might have been end of 2019. So we definitely didn't have quite the base yet. But once we bought those properties, we started to consume even more content, bounce even more ideas off of each other. Now seeing that, hey, like this can actually be done with a pretty limited amount of money and resources.
Heck yeah, that's awesome. So can you give us? So you do a lot of Burrs still. I know you're big on multifamily now, but are you guys still doing Burrs and then keeping some, but then also wholesaling as well as flipping? Can you give us kind of what your full business model is?
Yeah, absolutely. So when we first started, we definitely were primarily focused on the residential side, single families, duplexes, small multifamilies, and just very quickly realized through doing, quite a few Burr properties, it was like, hey, $150, $200 in net cash flow a month. It's going to take us a really long time to scale to where we want to be. And so had the opportunity to purchase a 20-unit apartment complex. And that was our first taste of, wow, there's really some economies of scale that multifamily has to offer. So as far as what our business model looks like now, we primarily market on the residential side for single families to fix and flip, and then primarily commercial, multifamily properties for units and up. And really we were, I would say, forced to pivot that direction because the valuation on a Burr single family from a refi proceeds makes sense, but they don't cash flow now that rates have risen so drastically. And so that's really why we've, pivoted towards just flipping the single families and working to build our rental portfolio on the multifamily side, because there are still ways to get kind of cash flow there. And just through some of the banking relationships that we've created now, we have a better opportunity to cash flow those deals.
So for our audience, you guys are fixing and flipping because that produces active income, so that you could take the resources, you live off of some of it, and the rest of it you're throwing into multifamily, trying to get that financial independence, that financial freedom. And you're doing that from Connecticut. Where are the properties that you're investing in?
So all of our properties that we currently own are in the secondary markets of Columbus, Ohio. And going into 2023, we did start marketing to a few select markets in Indiana and Kentucky. But that's really the extent of where we plan to geography-wise kind of scale to. We think sticking to these 3 states offer more than enough opportunity for us for the foreseeable future. So that's kind of the dynamic of where the properties are. And then as far as some people thinking probably, how does that work? So Ethan lives out here outside of Columbus. So he handles more of the interface with the property management company, along with the project management and overseeing the contractors and making sure, work's actually being done. I'm more on the acquisition side, the underwriting, interfacing with the banks, and just any of the back end logistical things that can be done virtually. And luckily, we both are definitely inclined to the things that we're doing. So it's really not like we're forced to do things we don't want to do. Ethan is much better dealing with contractors. He's better with dealing with confrontation and all of those things than I am. And I'm a little bit more, we'll say, technologically advanced. Ethan's not a computers guy. So it's just an interesting dynamic that fortunately works out for, our certain aptitudes.
Nice. And I believe you're doing a lot of direct to seller marketing as well, correct?
Yeah, we've definitely kind of pivoted over the years, just based on, I consider myself a very lazy marketer. And so we started with a lot of cold calling, texting, and things like that, where there's a lot of follow-up involved. You might be talking to an owner for, in our case, like we've talked to certain owners for over a year before we end up getting a contract. We have one that we've been talking to for almost 2 years. And so it's just a very long game. And again, being kind of lazy, we've started to move more towards the mail side for commercial properties because people call you when they're ready. You get very few phone calls, so it takes up less of my time. And that's really like where we've kind of pivoted to, and we stay consistent with the mail because of those things.
Nice. And do you have like a real niche market? Do you do like what's your kind of buy right criteria? You're doing 4 to 20 units that you're marketing as far as the mailers are concerned, or?
Yeah, so we keep our criteria pretty open, and I think that's mostly because we are okay buying older properties, especially on the smaller side. We've got 4 units built in 1900s that were completely redone. So we don't like to rule things out. We'd rather keep things broad, have a lot of conversations, but ultimately, say no if something doesn't meet our criteria. As far as like what we're pulling, we actually will market just 4 to really anything, because the way that the county auditor websites pool data is typically by land use code is how we're pulling our marketing lists. And so it's really just 3 lists, 4 to 19 units, 20 units to 39 units, and 40 and up. So when you're pulling directly from the county auditor data, it's harder to specifically say, I'm only looking for 50 units and under. So that's kind of what we found. And we thought by going directly to the source, yes, it takes a little bit longer to pull the data. It's more time consuming, but you are going directly to the source, and there isn't like a middle software that's pulling that data and potentially missing, opportunities.
Talk to us when you got that first 20 unit deal. Talk to us about the mindset that you had. I mean, jumping from a couple single families, a couple duplexes, triplexes, those sort of things, all the way up to 20 units. That's a big jump. So share with the audience a little bit about like, how'd you guys feel? How'd you find it? How'd you take it down? And did you find partners along the way? How'd you fund it?
Yeah, this is definitely kind of a pretty interesting experience for us. We actually texted the owner on a high equity campaign for residential properties, not realizing that this older farmer actually owned this 20 unit apartment complex, and he really wasn't running it like a business. He had 4 units vacant, 2 are being used as storage. 2, he was like, I'll get to them when I get to them. So right off the bat, we had no idea how to even analyze this thing. Rents were like averaged out $525 a unit. Market rents in the area were significantly higher. So right off the bat, we literally just Googled a YouTube video, how to underwrite a multifamily property, and read somewhere along that, that process that a 10 cap would be a good deal for us. So I take his numbers and a 50% expense ratio, and he's at $1 million. And I say, yeah, I think we're at 600,000. And he doesn't even respond. A couple weeks go by and he sends us another text and goes 850. And I'm like thinking, who is this guy? Like, I didn't even remember it at first. Go back, I'm like, unfortunately, we're still at 620. Month goes by and he responds, best I'll do 750. And I try and call the guy. He will not talk on the phone. He only texts. So, Ethan and I start talking and we go, we ought to figure out how to actually underwrite this thing. There might be something there, $38,000 a unit for, per unit for 20 apartments. Seems like there might be an opportunity there. So sure enough, we underwrite it, and, 750, we end up getting the property under contract. Our plan was to go in with like a kind of a hard money lender, renovate the units. We had a $10,000 renovation budget per unit, and we figured we'd do about 10 to 15 of the units and just leave 5 as is. And so feel free to like ask any specific questions, because I might breeze over some of the details, but we ended up getting an appraisal done and the property appraised for significantly under what on the after repair value, it appraised for like $1,050,000. And our renovation budget with everything was going to be around $150,000 to $200,000 plus the $750 purchase. And so this is a week and a half before we were supposed to close it. We were going to bring in a private lender to essentially bring our down payment and enough rehab funds to get the draw process going. And so in a week and a half, we had to like figure out how the hell we were going to buy this thing, because we felt just so confident that rents were so low. We had the ability to renovate these units, bump rents. And we ended up buying the property with 100% private money. So we raised all private money for the purchase and the renovation budget from 3 different investors. So that was definitely, looking back, like kind of crazy that even happened, that people, saw that, hey, we don't really have experience with anything this large, but they could tell how passionate we were. They could tell we had a plan. I'm not going to say it's a good plan because it wasn't, but they kind of gave us, a chance and saw like, hey, this property does have potential. So we ended up purchasing the property. The contractors we had at the time were absolutely awful. So it took us like 5 months to renovate one unit. And we started going, hey, this isn't looking too good. It cost us about $18,000 to renovate that unit instead of the $8,000 to $10,000 we had underwritten for. And just to kind of fast forward, we ended up, working out the renovation side of things. Our budget turned into about a $350,000 budget. Our pro forma rents turned into, who knows, $750, $800 to $950 to $975. So we ended up bumping rents and refinancing out of that project in November of 2022. The after repair value came in over $1 million higher than that initial after repair value appraisal. And we were able to do a cash out refinance, pay off all of our private investors. Ethan and I maintained 100% equity of that deal. And currently we ended up renovating 17 out of the 20 units. So there are 3 tenants that saw what we did with the place. We're fine paying more, slightly below market in unrenovated units. So it's a property that we, plan to hold for the long run, but kind of just a crazy, the way things came together. We're certainly very fortunate and retroactively look back and are thankful for, most of those private investors that took a chance with us.
Dude, Matt, this might be one of the best damn deals we've heard of on this show. Can you get into, Kevin, obviously you're new, you were new, I should say, learning through the process. How'd you find these 3? You don't have to get into the details, of course, but how'd you find these 3 private lenders?
Yeah. So the first one, well, actually 2 of the 3 are relatives. So one of them is, we'll just say he's a corporate America guy. He doesn't have a lot of time to personally invest his time into, real estate, but likes, the idea of passive income, and had a pretty significant amount of capital to deploy. So he covered the vast majority of that purchase. And then the other lenders that basically funded the rest of the purchase price and the renovation budget were on unsecured notes. So definitely a lot of trust there as far as, just, hey, I don't need to be in a position alone on the property. I trust you guys. And I'm, definitely super fortunate of that. So I think the biggest thing that I most often tell people that are trying to raise money, whether it's in a syndication or for a specific project, is you have to really believe in the project, and again, we didn't have the best plan. So I think it was definitely, those investors could tell that we were very passionate about the project, and we really believed that rents could be increased substantially. The second thing is we knew the deal inside and out. Even though we didn't know the renovation budget, we just had a very good understanding of kind of the operations, even though we executed poorly. And I think because we were able to articulate that well, that also aided in our ability to raise the capital in such a short time period.
No, heck yeah. And me and Matt do the same thing. You underwrote maybe the construction a little lower than you first thought, but then your pro forma rents were extremely low. I mean, you right. Took those $200 times 20. I mean, that's huge increase on the NOI. And it's always interesting, right? You ever notice, Kevin, I feel like all appraisers, and Matt, I'm sure you've noticed this too. So many appraisers say, oh, no, we can tell, we have a formula. We can tell exactly what the property is going to look like when it's done and what the NOI is going to be. So we will appraise it exactly how it's supposed to. And they never come in where you want them. But once it's done and it looks polished and the paint's dried, all of a sudden it appraises for $1 million more. I mean, that must have been a huge, I don't know what the word relief is. Just it must have been on your end just such a success to put in all that time.
Most definitely, yeah. And I think looking back, we were working with a lending company from outside of Ohio. Wasn't familiar with the area. Had no appraiser or any relationships really. And so that appraiser came from 3 hours Cleveland area to come down south of Columbus. He appraised pro forma rents at $600 a unit. And it was just, we probably didn't do a good job of portraying our plan onto him. But again, just a huge discrepancy there in how the deal turned out versus what they said was going to happen. So,
Kevin, how's your process changed with appraisers now as you guys have gotten a lot more experience, and how do you help to like tell the story of what you're trying to do with the property?
Yeah, that's a great question. So we create pretty much like a project narrative. It's usually just a one-page Google Doc explaining if it's a refinance, everything that we've done, and really just an overall like kind of what our business model is at a larger scale as well. And then talking through kind of our analysis. We provide comparable sales that we see on multifamily properties. We provide not only a cap rate scale, because I personally think a cap rate scale is a little bit BS. You can manipulate numbers. What ultimately matters more than anything is, does it hit debt service coverage? Because in our eyes, if it hits debt service coverage and it cash flows, that's more, banks are going to lend on that. And we've been pretty successful recently on portraying that to a couple different lenders. We've had a few refinances close in the past couple of weeks, and that's gone over really well. I think more importantly than that, though, we work with a broker. And I know some people have great banking relationships, so they think, I don't need a broker to cut out kind of the middleman. But we work with a broker who's through Marcus & Millichap Capital Corp. And phenomenal, A, what he shelters us from, and B, how he can really speak to the banks and the appraisers in a way that they actually listen to him. Like, they listen to him. And he knows, he's very like Midwest focused. So he knows the people that he should know that we wouldn't have time to build relationships with. And that's been really effective on not only getting appraisers, where we need them, but also pushing back on lending terms that we wouldn't have even known were negotiable. And next thing, we're getting extra interest only, or we're getting these things that, makes a big difference.
I think there's two things there for the audience. If you take away two things from this podcast, it's one, don't be passive in your appraisal process. Put together a one-pager. We do this in all of my projects, every single one of them. We have a one-pager that goes through what we did on the property, what comps look like, what we're going to be doing to the property if we're going to be going through a renovation and so forth. That way we can influence the decision, because that matters, right? It matters on your rate. It matters when you go to resell. It matters how much you get to pay back your investors when you go to Burr, if you're going to be burring. And I forget what my second point is. Oh, the second point, get a broker, right? Kevin, you got a broker. I've never done that. I think that's a genius idea. Someone who can spit the game with the banks, with the other appraisers, to make sure that they're influencing the outcome. I mean, those are great. Those are great solutions to help you get what you're looking for out of this.
Absolutely.
Oh, heck yeah. I mean, I also think having that, the broker is that third party advocate for you, and I think, Matt, we got to start doing that. That makes perfect sense. Like, clearly when me, Matt, or Kevin are doing a deal and we're speaking to the bank, they know, or the appraiser for that matter, they know what we're looking for. We're looking for the highest number possible. That a third party advocate for you is obviously looking to help you out, but I feel like a lot of times the bank or the appraiser will listen to them a little differently because they're outside of the deal, so that's a great idea.
And maybe one other point to hit on there is, like, our lending experience has been absolutely horrible. I mean, I can pull up my Google contacts and show 50 banks that I've spoken with, and a vast majority of them have screwed us along for a long period of time where, yeah, we can do this. And then they stop responding, or all of a sudden the terms are not what we talked about at all. And I'll attribute part of that to, like, our age. We've only been in real estate full time for going on our third year. Like, we didn't have a huge track record when we initially started. So, the broker on our side definitely helped shelter us from some of those things as well. And, even recently, just a smaller deal that we just closed comes to mind, where he really kind of stood up for us to the bank when they wanted to change some terms. And, he really pushed back hard, and we ended up getting the terms that were initially quoted to us on the term sheet, and, everything worked out. So I will never knock paying, that 1% broker fee. And firsthand, we've just seen it pay off so much value for us on that end.
Absolutely. So, Kevin, can you give us an idea of where you're looking to go? What's the next, 1, 3, and 5 year goals for you?
Yeah, absolutely. So we do plan to continue to scale in the central Ohio market as well as into Indiana and Kentucky. So we do have a couple projects in the pipeline in a few markets, and we love connecting with others in those markets as well, because neither Ethan nor I are physically there. But that's really the 3 states is kind of where we plan to continue to grow. As far as we don't have a unit goal. I would say we don't have like a certain number of units we need to own, but we do look at our passive income goals, and we want to continue, to obviously scale. One thing that we've really realized is real estate, and I know Bill Ham mentions this a lot, but cash flow will not make you wealthy. And that was maybe the one downside of us diving into real estate full time, was the $200 net cash flow door really does take a long time to scale. And the point of cash flow is to allow you to not be forced to sell the property, to actually gain equity in the property. And where you really make your money is on that equity creation, because you can cash out refinance when rates are down, whether that's in 2 years, 5 years, or 10 years. And we've just started to realize that even on some of our smaller commercial deals, where maybe the deal's net income is only $10,000 a year, but our ability to do a cash out refinance yields us $150,000. And that was really eye opening for us. So we are looking at some of those, equity creation plays where it's a pretty substantial value add. Maybe there's not, significant cash flow for potentially years if rates continue to rise or stay even where they are. But knowing that A, we're not forced to sell, and B, when the market does come back around, it's going to be just a phenomenal opportunity for us to capitalize on that equity creation. So maybe not as specific as you're going for there. So I'm happy to dive into any components of that, but that's really, the types of opportunities that we're looking for.
Yeah, no, this is exactly what Anthony and I are all about. We like value add, true value add opportunities, not let's just raise rent $200 and call it a day. We want to come in, do some construction, force the value of that property substantially higher based on renovations. I tell people in the single family space, when you buy a $100,000 property, you put $25,000 into it, the value isn't 125 now. It's not plus 25,000 where you were. It's far higher than that because the marketability is way higher. Right. And so it's true in the single family space. It's true in the multifamily space. Going out there and creating that equity, creating that value, that's what will make you wealthy long term. You're right. Cash flow. At the end of the day, that's what matters, but it's a slow build. You get there over a long period of time. Doesn't matter how many doors you have. Matters how much cash flow you bring in. You can have 1,000 doors and make $2,000 a month, or you can have 1 door and make $2,000 a month. So at the end of the day, cash flow does matter, but how you get there, it matters more importantly. And if you could get there through doing a cash out refinance and make $150,000 in equity and be able to live off of that, it's a lot easier than doing it off of cash flow. That's awesome, Kevin.
Absolutely.
Kevin, what's your portfolio look like in total at this point?
Absolutely. So Ethan and I personally own just over 50 units between the two of us. The largest is that 20-unit apartment complex, a bunch of smaller multifamilies, a handful of single families that we did purchase when rates were lower. And then we own 2 mobile home parks with partners. So we are minority partners on those. Those are pretty interesting opportunities. Obviously, the mobile home park space has really blown up over the last couple of years, I think in part thanks to Brandon Turner, but definitely some nuances to learn there, and certainly can be, cash flowing machines, also some increased liabilities with underground utilities and things like that. But, likely it's been a good experience for us, but we do think we'll stabilize the 2 parks and likely not purchase anymore and just really focus on the multifamily and kind of try and master the operations there and continue to scale in just one direction versus building the multiple bridges at once and ending up at no destination. So
nice. Do you plan on continuing the flipping business for foreseeable future, forever? I know my esteemed colleague Matt here, he kind of flips and develops to get into multi and maybe one day just stick with multi. Is that your thought as well, or are you looking to kind of stick with the long term?
That's exactly our plan. We would like to be, 2024 would be our last year flipping. And then we're primarily just 100% focused on the multifamily. And I think really when you can, bring all of your attention to one thing, you can really be successful and scale exponentially faster.
Kevin, I'd challenge you, my friend. What I'm doing in that case, I'm moving the same direction as you, right? My attention's going into multifamily, but I'm hiring people, highly skilled people, to take over the flipping business because it's a cash cow, and it allows us to live the lifestyle that we like and so forth. So I challenge you to look at your business, see if you can do the same thing. Bring in super high caliber folks to scale the flipping business further than you guys could yourself, allowing you to still pay, really, really, really good people, talented people to run that business and still get paid to own that business. Step on out, use your time in a different way like you want to.
That's a great point.
I feel like I'm missing the boat. I feel like I'm going to be the only one who goes from multifamily into flipping. I feel like, I'm always talking to flippers. I have to try this a few times.
Anthony is a super high-powered sales guy. Don't let him fool you. He's doing really well for himself. He doesn't want to be flipping houses in these hoarder houses and houses full of poop that I've been in for the last couple of years.
Just one then. I'll just do one.
Okay, fair.
Awesome. All right, Kevin, this has been an awesome, awesome time. I really appreciate you. We obviously know each other pretty well. We've broke bread and had some drinks before, but I love getting to know your story a little better. Please tell the listeners how they can get a hold of you, or what's the best way to reach out to you.
Yeah, Facebook, just my name, Kevin Kozak, Kozak. I'm trying to be pretty active on there. I interact with a lot of people through the direct messages on there. Our business website is Red Door Equities. So we do a monthly newsletter, just kind of keeps people in the loop of upcoming projects, current projects, and kind of what we're seeing in the Central Ohio markets and really the Midwest. So those are probably the two best places. But yeah, love for anyone to reach out and connect.
Kevin, great to hear your story. It's a pleasure having you. Have a great day.
Thanks, guys. I appreciate it. Take care.
Thank you for listening to The Money Tree Show. We hope to inspire you to achieve financial freedom. To see a sample real estate deal, head over to www.themoneytreeshow.com.